SoFi Technologies is trading live at $30.34, and it's pulling back slightly, down 0.65% in a relatively quiet midday session. But this small dip, this tiny flicker of red on the screen, is a perfect illusion. It is incredibly deceptive. The real story here isn't this minor, low-volume intraday drift. The real and far more powerful story is the massive, coiled spring of institutional money that has been quietly changing hands under the surface. The expectation for SoFi for the last several quarters has been that it's just another volatile, high-beta Fintech stock, a name you trade on your Robinhood app for a quick pop. The reality is that this company is on the verge of its final, most painful, and most important transformation, and this 0.65% dip is just the market taking a breath before it's forced to decide if this transformation is a success or a catastrophic failure. The common belief, the one you hear repeated constantly, is that SoFi is the all-in-one financial super app for millennials and Gen Z. It's the bank of the future. It's the story that gets people excited about online investing, the idea that you can buy into a company that is fundamentally disrupting the old, archaic banking giants. People see SoFi Invest, the company's brokerage arm, with its SoFi Robo-Advisor and SoFi Active Investing platforms, and they think it's just a sleek, modern, user-friendly alternative to setting up a traditional Fidelity brokerage account or an individual brokerage at a legacy firm. The expectation is that this is a technology company, first and foremost, that just happens to be in the financial space. It's the narrative of a disruptor, a stock that should be spoken of in the same breath as other high-growth names. But the reality is that SoFi is not a tech app, not anymore. This is the single most misunderstood fact about the company, and it is the key to understanding all of its volatility. The reality is that SoFi is a fully regulated, FDIC-insured national bank, and this 0.65% dip, pulling it back to $30.34, is happening in a market that is utterly terrified of what that means. Wall Street wanted a high-growth, asset-light, high-margin software business, something that looked like NVIDIA stock or Apple stock for the financial sector. What they got is a high-growth, lower-margin, capital-intensive, and heavily regulated bank. This identity crisis, this profound disconnect between the story and the business model, is the root of all the chaos we see in its chart. The company is no longer just a slick SoFi investing platform, it is a balance sheet that is now being stress-tested by the most aggressive interest rate cycle in a generation. Let's dissect this recent price action, because this small dip today is part of a much more brutal trend. The stock was hammered after its last quarterly earnings report, and this has baffled many retail investors. On the surface, the numbers looked fantastic. The company reported another beat on both the top and bottom lines. It raised its full-year guidance. Again, it showed record growth in members with millions of new accounts. It showed record growth in deposits. So why, after such a seemingly stellar report, did the stock plunge? The answer is what separates professional analysis from retail hope. The pros, the traders on Interactive Brokers and the portfolio managers at Fidelity, weren't looking at the member growth. They were looking at one thing and one thing only: net interest margin, or NIM. The macroeconomic pressure of a higher-for-longer interest rate environment is a direct assault on SoFi's business model. The expectation was that SoFi's bank charter would give it a dirt-cheap cost of capital from its own deposits. The reality is that in this environment, all banks are being forced to pay up for deposits. SoFi is in a street fight with everyone from Fidelity Investments, which offers high-yield cash management, to your local credit union, all competing for customer cash. This competition is squeezing its margins. This is what the big money is worried about. The entire financial sector has been under a cloud, and SoFi, as a high-growth bank in training, is getting hit the hardest. This isn't a simple Robinhood stock trading momentum play anymore. This is a deeply complex financial trade, and we've seen massive institutional block trades in recent weeks. This suggests that large Fidelity mutual funds and hedge funds are either dumping their positions, fearing a credit cycle downturn, or, more interestingly, quietly accumulating, betting that this short-term margin panic is a massive long-term buying opportunity. The last earnings call was a complete battleground. Management, led by CEO Noto, was celebrating the member growth, the strong personal loan origination, and the continued success of the financial services productivity loop, the idea that members come in for one product, like SoFi stocks or a loan, and stay for 5. But the market and the analysts on the call were grilling them on deposit betas, how much they have to raise their savings rate to keep customers, and their outlook for margin compression. The reality is that SoFi has two companies. It has the high-growth consumer bank and lending business, which is what everyone sees, and it has its technology platform, Galileo, which is a B2B business that provides the back-end infrastructure for other fintechs and banks. This tech platform is the hidden jewel, the part of the business that analysts hoped would give SoFi a tech-like valuation. But that story, that powerful narrative, is being completely drowned out by the macro noise of the consumer bank. This is the danger of the all-in-one model. The market can't figure out what to value. Is it a bank, which trades at 10 times earnings, or is it a tech platform, which trades at 30 times sales? This confusion is why a simple intelligent portfolio algorithm or a Schwab intelligent portfolio system might be programmed to sell it on financial sector weakness, while a human Fidelity wealth management advisor might be pounding the table arguing it's a mispriced hybrid. For those who are new to this name, perhaps just setting up their self-investing plan or looking for investment help on investing sites, it's important to know where SoFi came from. It was founded as social finance, and its original business was refinancing student loans for high-earning graduates from top universities. It was a brilliant, low-risk model. It went public via a high-profile SPAC, and its CEO, Noto, formerly of Twitter and Goldman Sachs, has been on a relentless, and I mean relentless, mission to build a one-stop shop for your entire financial life. This is the grand vision. It includes SoFi ETFs, Robinhood crypto-style crypto trading, personal loans, mortgages, checking and savings accounts, credit cards, and even insurance. It is one of the most ambitious visions on Wall Street. The acquisition of Golden Pacific Community Bank was the masterstroke that gave them the national bank charter, the key to this entire plan. But that vision has come at a cost. The stock's history is a complete nightmare for long-term holders. It's been a classic, brutal story stock. It has soared on hype, on CEO interviews, on new product announcements, then crashed back to earth on the reality of dilution, lockup expirations, and the brutal economics of banking. It has been a wealth destroyer for many who bought in at its SPAC highs. This painful history, this deep-seated scar tissue, is the expectation that every new rally has to fight against. People who bought Tesla stock or Nvidia stock years ago and held are celebrated as visionaries. People who bought SoFi at its peak are in a deep, dark hole, and they are now the bag holders who provide the selling pressure on every rip. This brings us to the core debate, the central conflict at the heart of this company. SoFi is trying to be your bank, your brokerage, and your tech provider all at once. Comment below, do you think this all-in-one model is a brilliant strategy for the future, or is it an unfocused mess that's doomed to fail? Looking forward, the outlook for SoFi Technologies is a true fork in the road. There is no muddle-through scenario for this stock. It is either going to be one of the biggest winners of the next decade, or it will be a spectacular failure. The bull case, the expectation that the longs are clinging to, is that the market is completely wrong about the margin compression. The reality in this view is that the bank charter is the ultimate long-term moat. It gives SoFi a cost of capital from its checking and savings deposits that no other neobank can legally compete with. As interest rates eventually stabilize and fall, that net interest margin compression will violently reverse and become a massive, powerful tailwind to earnings. The bulls believe the student loan moratorium ending, which was a huge overhang, is now a building tailwind for its original high-margin business. They believe the tech platform Galileo will continue to grow and that the market will be forced to re-rate SoFi as a bank plus tech hybrid, giving it a valuation far, far higher than a traditional bank. This is the grand slam scenario. The bear case, the reality that this 0.65% dip hints at, is that the bull expectation is a complete fantasy. The bear case is that SoFi is a subprime lender in disguise, a company that has only ever known a zero interest rate environment and a world of government stimulus. As a real credit cycle finally turns, as unemployment ticks up, the bears believe SoFi's loan losses will skyrocket. They argue that the company is trapped. It will never achieve the scale of deposits needed to compete with Fidelity Investments or JP Morgan. It will never have the marketing budget. It's stuck in a no man's land. It's not a nimble tech company,